Good day, YouTube. My name is Colin, and today's video is all about REITs. All right, thanks for tuning in. Now, this video was made because I received several comments about some interest in this topic. So the moral of the story there is, if you want me to make a video on something, just let me know. I'm more than happy to do it. This is a relatively small channel. I read and reply to all my comments, so feel free to leave a comment on something if you want me to make a video on it. Now, let's jump into it. This is going to be a two-part video. The first video, which is this video, is going to be kind of basics on REITs, what they are, the ways I use them to make money, and how you value them, how you evaluate what figures you're going to look at when deciding which REITs to purchase. Now, the next video is going to be the 3 REITs that I think are great picks moving into 2018. So if you already know a lot about REITs and you just are curious about which REITs I like, go ahead. You can just skip past this video and go to video 2. I'll go ahead and leave a link to that video in the comment section. All right, let's jump into this video. What is a REIT? So REITs, for those of you who don't know, are basically a way for anybody to invest in real estate without actually buying a building or buying actual property. Okay, prior to 1960, that was the only way you could really invest in real estate. Now we have these things called REITs, and they trade on a basic stock exchange, so you can buy them. I buy them on E-Trade. I've checked most REITs, most major REITs are available on Robinhood. There are public, private, and private traded REITs, just for the record, but primarily we're talking on this video about publicly traded REITs on stock exchanges. Now, it trades on a stock exchange. It is not a stock. Okay, it's a separate type of asset, and you don't technically own shares of a corporation when you buy a REIT. You own trust, and you don't actually have a stock. You have a unit. All right. Why do we even care about this? Is this just semantics? Because it's very similar to a stock. But the reason I point this out is because you're not receiving capital gains as much. When you receive the income on these, you're actually receiving what's considered ordinary income, and that has tax implications. All right. In order to qualify as a REIT, a corporation has to meet certain criteria. Primarily, one of the big ones is that they have to primarily be invested and looking. It has to primarily be a real estate company that invests in real estate, and they get certain tax incentives. The entity that is the REIT gets these tax incentives by paying out the equivalent of 90% of what they take in directly to the investors. All right, that's people like you and me that are buying these trusts on the stock exchange. And by doing that, they avoid paying corporate taxes, right? So they avoid all these taxes, and they end up paying the money straight out to investors. Great deal, right? Huge, which is a great thing and a great incentive for them, and something that stocks don't get to do, that REITs get to do. And by doing that, they avoid paying a lot of taxes, and that directly benefits you as an investor. Now, because they don't have to pay the corporate taxes, they pay out 90% of what they take in to the investors as ordinary income. And this is taxed differently than, say, a dividend. Even though you receive the money just like you would receive a dividend, they are taxed at a different rate. Now there's a very simple way to avoid paying these types of taxes, and that is where you put your REITs. If you put your REITs in your retirement account, like say if you have a Roth IRA, which I recommend everybody has, in addition to if you do your personal investing, also have a Roth IRA, because there's so much tax incentives in setting that up. And as many of you probably already know, when you set up a Roth, you don't have to pay taxes on anything you gain from those investments. So for that reason, I recommend using this type of investment in a Roth IRA. That's where I primarily do a lot of my REIT investing, because you get the best of both worlds. where the entity that you're investing in, the REIT, avoids paying corporate taxes, and then the gains that you get, you don't have to pay taxes on because they are in your Roth IRA. So that's how I do most of my investing, so that I try not to give up too much of my gains in the form of taxes. So moving on, how do we value REITs? How do we pick which REITs to buy? You know, there's a lot of things that I generally use when I'm looking at a stock that I don't use when I look at a REITs. One of the biggest things is the PE, the price to earnings ratio, because REITs are primarily dealing with real estate, and you really want to be looking at things like depreciation, amortization, and generally the property, right? So one thing that a lot of people will look at when looking at a REIT is how much the value of the assets, the value of the property in relation to how much debt is outstanding. A great thing to look at. All right, now let's move on to valuation. How do we value these REITs? Now, it's going to be a little bit different than how you value a normal stock, right? So one of the first things is these are not primarily going to be companies that are like growth type companies and that type of thing, because they're paying out so much in dividends. You're really relying on those distributions for most of the income that you receive from your REITs. So always be looking at reliable, we'll call it dividends, even though I already explained it's a little bit different, but I'm going to get myself mixed up because I always call it dividends. So disclaimer, when I say dividends, I mean your distributions. One of the things you always want to making sure is that there has been a reliable history of payments. If you're not seeing that, that would be a massive red flag. Okay? Another thing is you're not like in a stock where one of the first things I always look at is the price to earnings. When you're looking at a REIT, you don't want to just look at the PE. You want to also be taking into account the depreciation and the amortization, as well as the earnings, and also looking at the gains in sales. So all of this is taken into account if you look at the price in relation to what's called the FFO, which is considered called funds from operations. All right, one more time. That is price in relation to depreciation plus amortization plus earnings minus gains in sales. Now, to take that one step further, if you're able to find this figure, it's another thing to look at, and that's price to adjusted funds from operations. And that will also take into account any kind of one-time fees, something that's not going to be reoccurring, because you know sometimes that could skew the FFO or the funds from operations. So if you can find the figure that would take out oddball purchases or oddball expenses that were in a given period, that's probably an even better thing to look at. And this isn't something like when you go on Robinhood or you go on Robinhood, or you go on E-Trade, you don't always just see this. Like, those are set up to give you the figures for how you would evaluate a typical stock. So sometimes you have to do a little bit more digging when you do your research for your REITs. Okay? The last thing that a lot of people look at, because REITs are real estate investments, is the total amount of assets, because real estate investing is a lot about just building wealth through buying and holding properties, right? So there you have it, a brief overview. If there's anything else you would like to know about REITs, just let me know in the comments section, and I'd love to, like I say, I read and reply to just about all my comments. So now I am going to go ahead and make a second video where I'm going to talk about 3 REITs that I really am excited about and like you to start looking at if you're interested in investing in REITs. Thanks for watching this episode of Financial Success.